Good morning, ARMR Insiders. Welcome to the morning call. Thanks for joining. Thanks all of you for joining. This is the ARMR Report. We talk about the stock market here. I share with you the ARMR investing way, three-stage process, build our whiteboard, use algorithms that are proprietary for our entry and our exits, for our risk on, risk off decisions, wrap it all up with stop losses to protect ourselves. So I'm going to share with you today my wall of worry. Okay, I don't usually talk like this. I don't usually spend time discussing walls of worry because they're usually climbed. Okay, but I'm concerned to a certain degree that I think it's worth sharing these thoughts with you. So once again, I'm sharing a guide of how I run my own personal capital. Okay, these thoughts are going to determine how I run my own money. And I want to share them with you, take them for what they are. Use them to your advantage if you can. I don't know your risk tolerance. I don't know your goals. So, you're going to make your own decisions in that regard. But I've been doing this over 30 years. I'm going to share with you some thoughts that are troubling right now. So the ARMR investing way, step one really is to use algorithms we've built on 8 indexes to help drive our risk decision. That's the S&P, the NASDAQ 100, the Dow, the small cap index. Those are the major 4 that kind of drive the bus. And then we have the momentum, the value, the IBD 50, and then the 2 ARC funds that we use to kind of capture the whole market essence. So generally speaking, and we express this in our risk monitor on the website here, just in case you guys are new to this, our risk monitor is right here. You click on that as an ARMR Insider, and you're going to see what color, simply red, yellow, or green, that expresses the tilt that these algorithms are telling us. So right now we're risk monitor yellow, okay? What's happening right now is we don't have confluence. We haven't had it for the last few months. So the first part of my wall of worry is when ARMR algorithms aren't communicating, right? When the indexes are going in different directions. So that's always the first step of how I put capital to work. And when that doesn't happen for, a couple of weeks here or there, it's no big deal. But when it starts to stretch out and become more and more of a negative divergence, I become more and more concerned. Because the fact is, with very few exceptions, maybe last year being an exception, we'd have to go look again, when all of a sudden there was pandemic news and all the markets imploded at once. But we have to take a look, maybe even last year, with very few exceptions, when the small cap index begins to go like this, as the S&P is going like this, the very foundation of the wall of worry begins. Okay. And so I've been talking about this for a couple of weeks. And for a couple of weeks, you could say, well, the small cap index is just lagging. Okay. It's just lagging. Okay. June was the last time it really attempted to make a new all-time high. All right. During those 2 months, June and July, we have the S&P doing this, right? Walking straight up with a quick little shakeout right here, makes new highs. All right. So to start my wall of worry, a couple weeks here and there, I get it, no big deal. But over time, okay, what the small cap index is showing you is that there's a hollowing out in the market, okay? It's not just the small cap index itself. There are sectors of the market that are blowing up. And the big indexes grind higher, and the big stocks grind higher. So this is a wall of worry, right? They're going to keep grinding higher until something happens that changes that. Here's another thought for you. We all rely heavily on gamma information. I do. I love it. It's very, very helpful. It's short-term, very powerful flows is what it is. And when a market is in a direction, it's going to continue in that direction until something dramatic changes it, right? And so options data is incredibly important. More and more and more people are relying on the data. That makes it more and more accurate because more and more people are relying on it. But bull markets build in complacency. The belief that you could constantly trade gamma builds in complacency. And not with the gamma guys who are creating it. They'll tell you, they'll come out and say to you, hey guys, There's tail risk, but nobody wants to hear that. Nobody wants to hear about tail risk. Everyone wants to hear about the fat part of the bell curve. Let's just keep trading it. And nobody cares about the tail risk. When the higher the markets go and the more accurate gamma is, hey man, what's gamma saying right now? It's beautiful. Call walls are rolling higher. Puts are filling in underneath. This suggests that there's support for the market if it goes down and upside opportunities because the call wall is moving higher. That doesn't stop the market from going down if there's something that changes. But there's such a reliance on that idea, call wall rolling higher, puts filling in, that there's just an expectation. The market's going to keep going up. Beware complacency in a bull market. These are my wall of worry I'm sharing with you, okay? My guess is markets are going higher, right? It doesn't make any sense to come out there and fight the Fed, right? Everybody knows market goes higher when the Fed supports it. So why am I sharing the wall of worry with you? I'm kind of setting myself up to look stupid. Market always goes up. What a waste of time. I've been doing this over 30 years, and maybe it's just sticking my hand in the fire too many times and finally learning. But August, September, October are the most dangerous months of the year. Hey, but Brett, the Fed keeps supporting the markets. The markets keep going up. Well, all you have to do is look at last year. This is September. Right here. This is September. I don't remember the Fed stopped supporting the market in September. Do you? September last year, the market was being flooded with Fed capital. The S&P went from the top of its channel to the bottom of its channel. And let me tell you, during that 2-month period, there was some massive destruction, like 50% declines in the innovator stocks. Just complete destruction. So the long-term holder says to me, who cares? The market just made a double bottom over a couple of months and then it went higher. I say, okay, man. If that's how you feel, you don't care about owning the wrong group that drops 50%. Hey, man, good for you. You must have so much money. You could just throw it away. You don't care. No point in listening to this conversation, okay? The problem is we don't know when this type of sell-off turns into something a lot more. That's the thing we don't know. In retrospect, it always looks like it's easy. Oh, this was easy, okay? It wasn't easy for anybody who lived through it, right? If you were in the wrong group, you got destroyed, right? The ARMR algos picked this up. We went to cash in here. We got the double bottom. We got long right here. We made a lot of money off of that. Okay. But I'm just sharing with you, you can't say to yourself, the market doesn't go down because the Fed's supporting the market. There was massive support last year. The market still got spanked in September and October. So there's no guarantee when it could be August. There have been some terrible Augusts. You know, sometimes it's the very end of October. I don't know where it is, but I know this is a difficult time of year. So that's just on my wall of worry. So these are just some of my thoughts, you know. Just thinking, going over my notes. I'm starting to see more and more money pile into groups that are traditionally defensive. We're seeing unbelievable chart patterns start to form in the utility space. Okay. Now, this should mean to us that interest rates are going lower. They're not going anywhere on the upside. So theoretically, that's really bullish for the market. Okay. But the flip side is money hides in utilities when it starts to get scared. So I don't know where rates are going, but I can see money starting to hide in utilities. And if this breaks out to the upside, it may not be because there's this realization that rates aren't going up, because we all know that. It breaks out to the upside because the market starts going down and people want to hide somewhere. And there's nowhere else to go because rates are so low. And so they drive themselves into utilities paying a over 3.5% yield. Okay. The big pharma stocks are blowing out, right? One of the biggest positions in the ARMR portfolio right now is Pfizer, just as an example. Okay. The big pharma stocks are blowing out all over the place. They look great. Pfizer, we own Bristol Myers. But as a group, they just look like they're about to break out. All right. I think it's PJP is the index, the ETF. That's a nice tight base about to go to new highs. We're starting to look at precious metal stocks again. God, don't tell anybody that. They'll think I'm crazy. But there's a double bottom at the higher low. This is a nice setup here. And I'm seeing a number of great looking chart patterns in big cap, slow moving dividend payers. That's where people hide. That's where institutions hide. So this is just a wall of worry, right? When you get Amazon implosion on earnings, you get things like Pinterest collapse and other names. So all of a sudden, the growth stocks are starting to get questioned and dumped. Even stocks that have great earnings announcements don't go up. They start selling off on the news. And money rotates to the defensive sectors. It's just another brick in the wall of worry. That's all. And I'm going to wrap it up in a bow of a conspiracy theory. Are you ready for this? This is just for fun. Put it out there. There's always something that triggers the black swan event. In retrospect, you look back and most people never get what it is. And I'll be honest, I'm probably, I'm making this up as I go along, and it's probably not going to be this, but I'm just going to throw this out there. Last year, market was rolling along until we had a pandemic started by, I think we can all agree now, even those who wish to argue with me over the last year, they can, I think, finally have to get quiet and admit that the Wuhan virus started, in fact, in Wuhan. Okay? We can call it other things. We can call it COVID, whatever you want. Okay? I don't care. But the fact of the matter is, it began in Wuhan, China. Now, I don't know why. I don't know how. Who cares? We're never going to know until Hollywood makes a movie of it. Okay? But that created the first black swan that happened last year. Now the whole economy is trying to recover. World economy is trying to recover on unstable footing. Not a lot of room for supposedly to support the markets, right? And now all of a sudden, the PRC deems it that it makes sense to start attacking different sectors of their democratic businesses. I mean, I don't know what else you want to call it. So they come over to this country, they raise a lot of cash from, I mean, no disrespect, from suckers in the US who give them money, even though the PRC tells you that these companies do not follow generally accepted principles, right? GAAP principles. They don't follow them, right? So the numbers are completely fictitious if they want it to be. You have no access to management. You can't have a conversation and know exactly what's going on in any of these companies that trade here in the US. But they come here and they raise a lot of money. So a lot of US citizens, pension plans, hedge funds, whomever, put capital into companies. And then the government of China decides the education stocks, those companies shouldn't be for profit. They should be nonprofit. The stocks drop 50% in one day after being down big for a couple months because everyone knew that was coming. Now they shift last night to attacking the gaming sector, and those stocks are getting whacked. What's going on in China? Right? There was a high-profile IPO here, and within 2 weeks they attacked the company. So they allowed the company to raise cash from the West and then wreck the stock by attacking the company and saying that it was doing things, I don't know, illegal, whatever. Does this bother you? Now, I've been saying for a long time, don't invest in Chinese companies. It's a simple opportunity cost of money. It's a risk management question. There are so many places to invest. The US, Canada, Europe, other places in the world, Australia, Australian companies. There's all kinds of places in the world where the rule of law at least has a a look of propriety. Okay? China tells you none of it's true. They're not going to follow the accounting principles, and they're going to shut down businesses whenever they want. Well, why would you ever put money in a Chinese company? How do you manage that risk? You go to bed at night, you wake up, they decided that businesses aren't legitimate. who? Here's the problem. And this is the black swan that concerns me. Okay? At some point, don't institutions and hedge funds wake up to the fact that what they own in China is complete and utterly opaque? That it's impossible to manage that risk. And don't they dump it all at once? And won't there be the hedge fund or institution who gets caught with his pants down, right? And blows up? Well, we're programmed to think, blow up's no big deal. Happens all the time. Fed bails them out. Well, Fed bails them out. Fed will probably bail out whoever blows up on the Chinese issue. At some point, there's a tipping point. And this is the rook on top of my wall of worry, okay? There's a tipping point at some point when the investing community in the US says, forget it. I'm not putting that kind of money in Chinese stocks. And the cards come down and someone's left holding the bag and you get a black swan event. And it doesn't matter how positive the gamma is, it's going to get ugly. I don't know when it's going to happen. Maybe it never does, because the Fed will always save us. Those are my thoughts for the day. What I will be doing is executing, following algorithms. I am carrying a fair amount of cash, and I don't feel compelled to run out and put the cash to work. If I find an idea here or there that sets up, we got the right algo entry point, fundamentals we think are legitimate because we're investing in the right places, I'll put some capital to work. But these are my thoughts for today. I hope they've been helpful to you to make you think. It's not that I'm going to be right, and who knows, that conspiracy could be just crazy talk. But it doesn't help for me to have this conversation with you after the markets drop 15, 20%. That won't help. So we got to talk about it now so you understand why we're carrying cash, why we're invested in more conservative stocks right now, and why I'm not looking to plunge into new sectors of the market. We don't have risk monitor green. Now's not the time to start grabbing momentum stocks. Okay? I'll buy a stock in a group that looks like this. There's no momentum here in the gold stocks. Okay. Nobody cares about them. Everyone thinks they're terrible. They don't ever make anybody money, blah, blah, blah. They've made us a lot of money. We made money on this run. We made money on this run, and we're going to make money on the next run. That's because we buy them when nobody cares and we sell them when everyone gets excited. Okay. Those are the stocks I'll buy. You know what I'd buy? Altria at a 7% yield. Those are the stocks I'll buy right now. Right? I'm even looking for room somehow to work this into the portfolio. Lumen Tech at a 7% yield. Real businesses, real cash flow, paying it out to shareholders. That's where I'll invest right now. Okay? In the meantime, we're going to focus on day trading. I got to get out of here, set up our live day trading desk, or should I say our live trading desk, because it's not just day trading we do. So I'll see all you ARMR insiders over there in a few minutes. Anybody got a quick question? I'm happy to answer it. It's, I appreciate that, Christian. I just, Christian's writing about interesting view on China. It's just, I don't get it. I don't get why anybody invests there. And I feel there's going to be this tipping point and it could get ugly. So be careful on all of those Chinese names. All right. BSX looks pretty good. Let's take a look at a couple of chart patterns before we go. ARMR insiders posting about these different chart patterns and stocks and companies in our Slack room. That looks really good, Eris. We probably should be focused on that group. And that's a more conservative group too. Let's take a look at Disney again. I'm concerned about Disney. Anecdotally, you know, my wife is in Orlando this weekend. This is an interesting story. She has a friend that was up there too, and her friend and her friend's family. Hello. Her friend and the family traveled all the way to Orlando to go to Universal. Hang on a sec, guys. Can I call you back, Angel? It's all good here. You all right? Yeah. All right. Love you. They drove all the way to Orlando to go to Universal, and there was a 4-hour wait to get into the park, to get into Harry Potter section. 4-hour wait. It was jam-packed. My wife was up there this weekend. She ran over to the shops at Disney just to pick up some things. It was like mass mayhem. So you would think that that's real bullish, but we're having this rapid rise in COVID cases. Who knows what they're going to end up doing? That's real bullish, right? I mean, it's just massive amounts of people there. So that's on a bullish note. But I don't like that chart pattern, and I'm a little bit concerned about owning a stock into earnings. I don't know. I mean, so far, it hasn't paid at all to own a stock into the earnings number. I mean, just very few. All right, Snap would have worked, right? Snap was a big run-up on earnings. But for every Snap, there's like 10 stocks that implode. So I just don't see myself buying Disney in front of the number right now. Yeah, I could be wrong. What else we got here? Oh, RL. Boy, Ralph Lauren looks good, right? Now there's a pattern I can get behind. That's a huge cup and handle on Ralph Lauren. Huh. That's a great looking pattern. And then we've got UAA, right? Under Armour. That pattern looks great. And don't forget, I'm a big fan of Levi's. Right? All these companies are having better than expected earnings numbers. Okay. PD DuPont's in a nice base there, and Dow's got a fat dividend. These are stocks on the radar. All right, guys. So those are some thoughts for the day. I'm going to, leave it on that picture because it's such a beautiful a chart pattern. We bought it right in here at the ARMR Report. So let's just enjoy that view. I hope you guys enjoy your trading session. Be safe out there. Take your time. Be focused. Okay. I'll see you all on the flip side. Take care, guys.